Well, good morning, everyone. My name is Jason Stewart. I'm an executive in residence at the Global Risk Institute. On behalf of GRI, I'm pleased to welcome you to the first event in this year's Macroeconomic Policy Webinar Series. Today's webinar examines Bank of Canada policy in 2025, the outlook for rates, and key factors shaping their path. Although this event is virtual, and many of you are joining us from across Canada and beyond, I want to take a moment to acknowledge that the Global Risk Institute in Canada is situated on the traditional territory of many nations, is covered by Treaty 13 with the Mississaugas of the Credit, and is now home to many diverse First Nations, Inuit, and Métis peoples. Through this land acknowledgement, we want to bring context to the history of our country and the importance of working toward reconciliation in all the ways that we can. Before we get started, a few housekeeping items of note. First, please be aware that this session is being recorded and will be shared on our website. Your microphones have been muted to avoid background noise. There will be ample time for questions during the Q&A period after the formal remarks, so please submit your questions through the chat to all panelists, and we will address as many as time allows. And lastly, when you exit the webinar, you'll be asked to complete our event survey. Your feedback is very important to us as it helps GRI continue to improve our programming. Please take a few moments to complete the survey when prompted. Our webinar today follows a decisive year of change for the Bank of Canada's policy rates, with large cuts totaling 175 basis points since June. In assessing the outlook for 2025, our speakers will offer their perspective on monetary policy, with a focus on nominal and real interest rates, inflation, and debt markets. We're delighted that Warren Lovely and Chris Ragan are back for their 5th annual GRI webinar, examining the outlook for Canadian monetary policy. We will begin our session today with remarks from Warren, followed by Chris. We will then move to the Q&A component with both. I'm pleased now to briefly introduce our distinguished speakers. Warren Lovely is a Managing Director with National Bank of Canada Financial Markets, serving as Chief Rates and Public Sector Strategist. Warren is a leading fixed income economist with a long track record of incisive articles on monetary policy and its impacts on debt markets. His prescient analysis and outlook last January included forecasting a faster pace of disinflation in 2024 and the need for greater policy rate cuts, both of which occurred last year. Chris Ragan is an associate professor in McGill's Department of Economics, and he founded McGill University's Max Bell School of Public Policy and was its first director. His outstanding career is well summarized in his webinar bio, including distinguished roles with the Bank of Canada, Finance, the Eco Fiscal Commission, and the C.D. Howe Institute. Chris's framework for understanding monetary policy last year and the Bank of Canada's challenges in normalizing policy remains very informative and timely. I will now turn the webinar over first to Warren and then to Chris for their presentations and opening remarks. Warren, please begin.
Well, thank you, Jason. And I know we have a lot of ground to cover, so let me just simply say, I think on behalf of Chris and certainly on behalf of myself, that it is a pleasure and honor to be here. 5th year in a row, Chris, so they keep asking us back. So we're going to do things a little bit differently this year. As Jason indicated, I'm going to kick things off with a cyclical and market-based discussion assessment. I'm going to hand it then to Chris for a more theoretical, academic, fundamental discussion of neutral policy rates. We hope this serves as and provides a nice counterbalance, and will hopefully provide more than enough fodder for our always engaging Q&A session. So I'm going to turn to my first slide here, if I could, and get right into this. And I think, as most will appreciate, where we are headed on interest rates and monetary policy is at least partly a function of where we've come from. Jason already loosely indicated what the current and ongoing easing cycle already looks like. It started in June, of course, so it's 7 months old and counting. It currently amounts to 175 basis points of cumulative easing. Now, no two monetary policy cycles are the same. That is true on the way up. It's certainly true on the way down. We also have a bit of a small sample size problem when it comes to empirical analysis and the statistical tendency identification. saying all that, the current Bank of Canada easing cycle maybe doesn't look all that extreme, at least compared to the prior 7 monetary policy easing cycles in the policy target rate era. We're kind of down the middle of the fairway, you might say. If we go to my next slide, please. I think where the Bank of Canada's actions and policy stance looks more extreme, more aggressive, is when you compare to what other major central banks were doing last year. None were more aggressive than the Bank of Canada, including, of course, the US Federal Reserve. So in a sense, Bank of Canada aggressiveness, urgency intersected with FOMC gradualism, you might say. This speaks as much to US economic exceptionalism, perhaps, as it does to Canadian lethargy and Canadian structural underperformance. It certainly highlights the idea and notion that the monetary policy transmission mechanism works pretty efficiently in Canada. It has always been thus, but the relative divergence in economic performance and policy rates is getting harder and harder to ignore. And on my next slide, I think it would also be fair to say that in many cases, the deviation and divergence in policy rates and bond yields are now at a level that many are unfamiliar with. We're not talking entirely unprecedented historic divergence. We've had policy rate gaps larger than 125 basis points. We've had 2-year bond differentials wider than the current roughly 135 basis points that you see today. But the last time Canadian bond yields were so far below the US was way back in the mid-1990s, which wasn't exactly a happy time for Canada when structural issues and problems were legion, much, I guess you might argue, as they are today. Now, the Bank of Canada assures us that we're not yet at the limits of monetary policy divergence versus the US Federal Reserve, and we tend to agree with that assessment. Although I think we maybe should just mention here that FX markets might be the ultimate judge, the ultimate arbiter in terms of how far apart policy rates and bond yields can get. There's certainly more to a Canadian dollar valuation than 2-year yield differentials. I appreciate that and acknowledge that. But on its own, the path forward for interest rates and policy rates doesn't look to be particularly supportive for Canadian dollar strength in the near term. If we go to my next slide, please. In terms of expectations, and really before I go any further, let me just say market expectations are a living and breathing thing. They change constantly. We will have very important data on Friday, jobs data both for the US and Canada. It'll provide another opportunity to reassess expectations on the Bank of Canada and the Fed. But as it stands, markets are now unwilling to discount even fully 2 25 basis point rate cuts from the Fed. There's notionally more significant and more timely easing from the Bank of Canada that markets have discounted. Now, I won't get into the full nuts and bolts of our economic forecast, but suffice it to say, our base case economic forecast would see scope for both central banks delivering more interest rate relief than what is currently discounted. But I offer that with a dose of humility because I think, simply put, markets, traders, economists, strategists have had a harder time handicapping central bank decisions, certainly for the Bank of Canada. Consider how much we generally, collectively underestimated the amount of tightening that was delivered in 2022. Consider that we underestimated the amount of residual tightening that was still needed in 2023. And consider that we generally, most, underestimated the extent of easing and the speed with which that easing would come in 2024. So again, some humility perhaps in order here. But if I go to my next slide, I would just want to acknowledge that there's and most will appreciate, a high degree of anxiety and nervousness in bond markets currently. And it's, I think, more than simply reassessing the path forward for the Federal Reserve and taking out Fed interest rate cuts. I think we can all appreciate that the economic outlook is highly uncertain here. Inflation, particularly in the US, inflation risks have not been put to bed. And if anything, they risk being inflamed, at least based on the policy options being contemplated by the incoming US administration. The US debt trajectory is its own risk factor, I guess you could say, with key thresholds on indebtedness falling by the wayside with somewhat alarming speed in the US, and no real easy to identify off ramp in the near term here. In fact, seemingly perhaps an acceleration in US indebtedness. So perhaps not all that surprising that bond investors are demanding more compensation and protection in the form of a larger and higher term premium. In the US market. Those 10-year term premiums that I'm talking about, well, that term premium is at the highest level we've seen in 10 years, although I think it would be unfair to call this normalization. We're not yet normalized here in our view. The path of least resistance may still be higher on term premium, and that risks the bear steepener, a steepening of the yield curve and higher longer term interest rates than would otherwise be needed. And that brings us to the great risk factor that we're all contending with right now. At what point do longer term interest rates hit a breaking point? Do they break US economic exceptionalism? Do they break risk markets, equity markets in particular? This is, I guess, a daily process of exploration. If I go to my next slide, please. I think we would argue strongly that the need for term premia and steepening of the yield curve is much less acute and warranted in Canada. Yes, I fully acknowledge we have our own economic uncertainty. We haven't fully eliminated upside inflation risks in Canada. We have our own political uncertainty. Political dysfunction might be a better label, perhaps. We have a structural deficit in the nation's capital, and at the margin, more borrowing to do. That's what the fall economic statement told us. As it stands, however, we strongly see the general government sector in Canada on a more fiscally sustainable path versus the US, certainly, and most other major advanced economies. Net borrowing needs, as a result, in our opinion, look much more manageable, even allowing for quantitative tightening. We might even get, believe it or not, a pivot to, quote, conservative fiscal policy following the next federal election, although there is an issue of defense spending I think the incoming government may need to address. More to the point, more vital, however, is the fact that the Canadian and US economies are just in fundamentally different performance zones. That's really what this chart is trying to highlight. Canada has been operating and running below its economic potential, opening up slack. The US has been operating and above potential, running above its speed limit. There's really an absence of slack in the US economy. And it's this relative dislocation between Canada and the United States that is more genuinely unprecedented. I go to my next slide, please. Nor is it a case, in our view, that there's like an easy and quick fix here to this absolute and relative Canadian underperformance. Okay, sure, interest rates are lower now today than they were a year ago. That is meant to be a partial balm for housing markets and interest rate sensitive demand. Consumers remain stretched, in our opinion. Business confidence is understandably shaky and low. Our factory sector has sadly been hollowed out. Exporters may well face something of an existential crisis if tariff threats are to be believed. Let me just say, generally, we think growth will continue to run below potential in Canada. More slack will, as a result, open up. Labor markets are likely to remain weak. They already are. They could get even weaker still, even if slower population growth slows the pace of erosion and deterioration in the Canadian labor market. Relative economic weakness in Canada versus the US is a surefire recipe for monetary policy divergence and bond yield gaps. If I could go to my next slide, I'm pretty much out of time, so I simply want to just highlight this and flag this slide as a placeholder, maybe something we'll come back to in the Q&A, I'm not entirely sure. But the Bank of Canada has that other policy tool, unconventional policy, balance sheet management or quantitative tightening. Now, balance sheet management was something of an afterthought or in the shadows still through much of 2024. There were some temporary factors that made that. So, without getting into the details here and the technicalities, let me just say that from our perspective, we see excess liquidity in the Canadian financial system, excess settlement balances being drained in 2025 and likely approaching the upper end of this notional steady state sometime in the second half of the year. So around that time, we also think the Bank of Canada will be approaching the lower end of the perceived neutral band for the policy rate. And if that's not a good segue to Chris on a discussion of the neutral policy rate, I'm not sure what is. So with that, I will hand it over to Chris and come back for the Q&A. Thank you very much.
Thank you, Warren, and thank you, Jason and GRI, for inviting us again. And I hope we behave well enough that we get invited back for the 6th year. Okay, so what I'm going to talk about is where we are headed, or how we can think about where we are headed. So this is really all about the neutral rate. And so I'm going to kind of put on my professorial hat, I suppose, and spend some time thinking about what we mean by the neutral interest rate. So what is it? Well, there are a few definitions floating around about if you do a Google search for what the real interest rate is. But I think the dominant definition is these 3 bullet points. Number 1, you've got an economy where real gross domestic product, or GDP, is equal to potential GDP. That's another way of saying the economy is at its productive capacity, or the economy is at full employment. The second thing is that inflation is at its target rate. So in that case, in Canada's case, that's 2%. And the third point is that all adjustment from past macro aggregate demand or aggregate supply shocks has already been completed. And so what that really means is, we're never really at the neutral rate because whatever shocks, shocks are constantly happening. But what this says is, if you can imagine those shocks happening and then the adjustment in response to those shocks taking place, and you wait until the dust settles, where would we be? And that's the neutral rate, okay? Now, following the last few years, and you've seen it very nicely in Warren's chart, we had this very rapid monetary loosening, and then we had a fairly rapid tightening, and then we had loosening again. So the last 5 years has been pretty interesting in terms of monetary policy. Most central banks are presumably headed toward R star, what we call R star, which is the neutral rate. But the question, of course, is what is the value of R star, and what are the kinds of things that make it change over time? So this is where we need a little bit of macro theory. So I think what I'll give you now is a very standard macro theory approach to thinking about the neutral interest rate. So you think about real GDP equaling potential. So I've called potential Y star. Inflation equals the target for inflation, 2%. And I think just to keep life simple, you consider a closed economy. If you wanted to think about the neutral rate globally, well, the global economy is a closed economy, but it's a pretty good way to think about things even for an open economy like Canada. Long-run macroeconomic equilibrium in a standard macro model requires that red statement that the supply of national saving equals the demand for investment. So you can think about this in terms of financial capital. There's saving that is coming from households, it's coming from businesses, and it's coming from governments. And that saving is providing financial capital. And then there's a demand for financial capital to finance investment in physical capital. So that's the equilibrium condition, that the supply of national saving equals the demand for investment. I can break that down here. National saving is the sum of private saving and public saving. So private saving is basically the difference between after-tax income and consumption. So for the private sector, that's private saving. And public saving, of course, is government budget surpluses. So a budget surplus is negative saving. A budget deficit is dissaving, okay? So private saving plus public saving equaling desired investment. And that equilibrium condition will determine R star, which is the neutral rate. So here is a diagram to show you what's going on. Forget about the green box for a moment. The diagram here is the market for loanable funds. So you've got the real interest rate on the vertical axis and the amount of investment or saving on the horizontal axis. And here you've got the red upward sloping curve is the amount of saving that is supplied to this market for loanable funds. And again, that's coming from private saving plus government saving. And in fact, I've drawn it to be fairly steep in keeping with the empirical evidence that, consumption is interest rate sensitive, but it's not hugely interest rate sensitive. So what's more important for this supply of national saving curve is as it shifts to the right or left due to changes in budget deficits or changes in underlying consumption behavior. It's not so interest rate sensitive. More interest rate sensitive is investment demand, the blue downward sloping line, but of course shifts in that curve are important as well. Now let me turn to the green box, because for the past 25 years or so, there has been a lot of discussion among macroeconomists about why R star, the neutral rate, has been declining. And there's if you look into the discussion on the neutral rate, or you look into the discussion on what's called secular stagnation, because that literature overlaps with the discussion about the neutral rate, you'll see that there's lots of things that are talked about. But what I've represented here in this green box are probably the four most important shocks that are talked about. One is rising income inequality. So for a given level of GDP, if more of that is going to the upper few percent of income earners, and less of that is for people in the middle, then what you'll find is that those higher income people will save more of their income than the lower income people. So a change in the distribution of income toward the rich typically increases the amount of saving and would shift this curve to the right and drive down the neutral rate. The second thing is rising life expectancy. As we get more healthy populations and our life expectancy rises from 80 to 82 to 85 to 87 years, what typically happens is that people end up saving more while they are working because they think they will live longer. And that leads to an increase in private saving and shifts that supply of saving curve to the right and drives down the neutral rate. The effects 3 and 4 here are on the investment side. So there's a lot of discussion about how there has been a changing nature of investment, especially with the rise of the internet and digital technologies. Then there's just less physical investment in machines and physical capital. And that has actually led to a shift to the left in the investment demand curve. The other thing is that there's been declining productivity growth. This is certainly true in Canada, but it's true in some other countries as well. And that lower productivity growth means that investment demand is less attractive, probably more necessary, by the way, but less attractive if you can't rely on faster productivity growth. So both of those things are leading, if I could switch my color here to blue, that might be dangerous. I don't know if I can do that. Let's just see. Oh, I can. Look at that. So those two things will shift the investment demand curve to the left, and those will lead to declines in R star. So the literature, of course, there's not unanimity on the estimates about what the neutral rate has done, but there's a fair amount of agreement that the neutral interest rate has fallen considerably over the past 25 years or so. And in fact, kind of the midpoint is it's about 3 percentage points. And you see some of that in the graph that Warren showed you on the term premium, is that has dropped dramatically since the 1990s. Some of that is just the reduction in the neutral rate. Okay, so now let's move to some data. Just one graph here on the Bank of Canada. So what you see is the blue line is the Bank of Canada's target for the overnight interest rate. This is a nominal interest rate. And you see the latest change has been just, at the very end of this graph, another decline of 50 basis points, so that the target for the overnight rate is now at 3.25%. If you wanted to think about what the real rate is, well, the reason why I have the real rate in quotes here is that getting a measure of the real rate requires you to subtract inflation expectations, and that requires you to have a pretty good estimate of what inflation expectations are. So I just come up with two sort of quick and dirty estimates here. One is I looked at the rate of core inflation, which of course is less volatile by construction, less volatile than actual CPI inflation. But since core inflation tends to be, precisely because it is less volatile, but still sort of averages out with overall inflation, it's maybe not a bad measure of expectations in a world where expectations are pretty well anchored to the target. And the other thing I've done is I've just subtracted off the actual target rate. So if you wanted to assume that inflation expectations are exactly at target, which is pretty close to the truth for a long period of time, but then it's not true at all during, let's say, the last 2 years, then what you've got there is two real measures there. And I don't claim that those are wonderful real measures, but they're kind of quick and dirty real measures. But what you also see here on the right-hand side is the bank's estimate for, or the estimated range for the nominal, not real, but the nominal neutral rate. And their estimated range is 2.25 to 3.25%. So what that tells us is that the bank's current target for the overnight rate is now exactly at the upper band of its estimated range. And it's redone these estimates very recently. So it is now in the ballpark of the neutral rate. Now, Warren also showed you some very nice graphs about the current state of the output gap in Canada and the labor market in Canada. And both of, it looked like the output real GDP was 2% below potential in Warren's graph, and in the US it was 2% above. So a real divergence in terms of the business cycle in Canada relative to that in the United States. And our unemployment rate has been rising and our employment rate has been falling. So it may well be the case that even though the Bank of Canada's target for the overnight rate is now in the band of the neutral rate, that for cyclical reasons, it will continue to lower that rate. It may well do that, although working in the other directions, it may say, well, we've now cut aggressively by 175 basis points, and now it will just watch, and because we know that those cuts will take time to influence aggregate demand and the labor market and the output gap and ultimately inflation. So maybe we'll wait and see. But what I want to end with, I guess, is where do we actually think we are going? Because this estimate of 2.25 to 3.25, the middle of which is, let's say, 2.75, is an estimate for the neutral rate today. It's not an estimate for the neutral rate at all times. The estimate changes because of the kinds of things that change the demand and supply in the market for loanable funds. So I think the question that we need to be asking, and this is a much more longer term question than most of what Warren was talking about, is, think about the next year or the next 3 years or the next 7 years. What should we be expecting? Well, so to me, what we need to do is think about where this market for loanable funds is likely to be going. Even if we think that 2.75% is a great estimate for the current midpoint of the range of the neutral rate, we want to know, where should we be thinking about going? Well, there's 4 things that I've written down here, and I'll just say them very quickly. It's pretty obvious that there will be an increase in government spending on health and elderly related things, whether it's health, OAS, GIS. OAS and GIS are the single largest items in the federal budget, and they are the fastest growing items, or at least recently they have been fastest growing items. So that greater government spending means that supply of national saving curve is going to be shifting to the left, okay? And that drives up R. Almost certainly there's going to be rising government spending on either defense or security or both. And that's just not an increase in spending. That's an increase in spending as a share of the economy. If we actually meet our NATO commitments within the next few years, and that will be hard, that will be an increase by itself. That will be an increase of about 0.7% of GDP in terms of higher government spending. So that means back to the market for loanable funds, that drives up the neutral rate. In Canada and in many Western countries, I think there is a need for replacing public infrastructure. I'm not talking now about new roads and bridges and port facilities, although there's probably an argument for that as well, but to replace the infrastructure that was built in the 1950s, 60s, 70s, and 80s that is now reaching or almost reaching the end of its useful life. And so that is going to be public investment, probably public investment, which is another force driving up the neutral rate. And then you have increasing both private investment and probably public spending in terms of energy transition. So this might be bigger and cleaner energy grids. This might be investment in carbon capture and storage, investment in nuclear facilities, whether they are small or large. There's lots of estimates, by the way, of the amount of investment that needs to happen over the next 10 years or so on energy transition. I think they are all over the map, but they all tend to be rather large numbers. And again, this is an increase in spending as a share of GDP. So I think there's pretty good reasons to think that the next 3, 5, 7, 10 years, if not beyond, is going to see an increase in the neutral rate. So what that means is we might see the Bank of Canada's rates go down a little bit more for cyclical reasons. Okay, back to Warren's graphs, quite good graphs about the weak current state of the Canadian economy. But I don't think we should be surprised if the estimates of the neutral rate are rising over the next decade or so, which means that the longer term target for the Bank of Canada, I think, has a pretty good chance of rising, not falling. And I will just stop there, and I apologize if I went overboard.
Chris, many thanks. And we'll pick up on that last point as we now move to the Q&A portion of today's session. A reminder to everyone to please put your questions in the chat to all panelists. We're looking forward to those, but I'll start the Q&A component with the debt markets and roll into the neutral rates as part of that. If we look at the US Treasury bond market over the last 2.5 years, at least 7 times it's tried to rally significantly and unfortunately has not been successful, as today US 10-year yields are well above 4.5%. 10-year Canada bond yields are modestly higher since late September, despite 125 basis points of BOC policy rate cuts since then. What lessons do you draw from the last 2.5 years for US Treasuries and Canada bond yields? And what should this mean for the Bank of Canada's policy setting this year? Warren, do you want to start?
Yeah, sure, Jason. I think that's a great question. I guess my initial reaction would be in terms of these bond rallies that have been consistently short-circuited is, I guess, to some extent, don't discount U.S. exceptionalism to some extent, or economic resiliency, right? Which I think we've been, well, if we're still surprised by this, I guess the question is sort of like Lucy with the football, you know, like why do we keep getting surprised by U.S. exceptionalism? But to some extent, I think that's part of a lesson. And that's forced, and we're seeing this today, is generally forced a rethink on how much accommodation the Fed can deliver. But there's more to it than that, I think, in terms of the current pressure on bond markets, Jason, that you point out. I mean, we've got 30-year Treasury yields kind of flirting with 5% now. You know, we're at levels now that are flagging concern and anxiety, and more than, as I mentioned in my prepared remarks, more than just simply revised expectations for the Fed. It seems to me that we're coming to terms with the idea that this U.S. exceptionalism, resiliency, hasn't come for free. I mean, it's been, let's be honest, fueled in part by very loose fiscal policy, unsustainable fiscal policy in the US. We've got really no slack in the US economy, as I tried to show, which means that any marginal bit of growth at this stage risks inflaming inflation and inflation expectations. That's not exactly a great recipe for for bond markets. And just the simple math in terms of the technicals of supply, when you're running such large structural deficits, are also not exactly helpful. So for a few reasons there, I think the pressure and the failure to sustain rallies in the treasury market is understandable. I think at the same time, the divergence and the deviation in economic performance and fiscal sustainability between Canada and the US is probably more acute than I can ever recall, at least in my career. So this divergence, to me, I don't think is fleeting. I think it's notwithstanding Chris's very good points about likely R-star moving higher over time. I think there's still arguments for Canadian interest rates and monetary policy to be set at what appears to be extreme levels, at least based on current history, but I think is entirely appropriate given what we're going through here in Canada.
For the next question, I'll direct this one to Chris first, picking up on the neutral rates. How different do you think neutral rates should be for medium to long-term bonds as compared to short-term debt, both for Canada and the US?
Yeah, I'm not sure I can add much value to comments about the term structure to anything that Warren has said. But let me just pick up on Warren had talked about fiscal exceptionalism, or American fiscal exceptionalism. We probably shouldn't continue to be surprised about that. There's something about that word exceptionalism, right?
Yeah.
But what I think there is a danger is that Canadians come to think that American fiscal exceptionalism applies to them. This is one of my concerns, that America is currently running 6 to 7% of GDP budget deficit. I don't think that's a great idea, but I think it's a less bad idea for America than it would be for Canada. And one of my fears is that finance ministers might, we've had some changes and we'll have some changes again. They might feel that what's going on in the US means that Canada can do that as well. And I think we've got to believe that we probably don't have Canadian fiscal exceptionalism. And at some point, I think the capital markets are going to tell us that maybe we've got enough debt. I don't think we are yet where we were in the early 1990s, but we're actually surprisingly close. If you look at federal plus provincial debt, we are fairly close to where we were when we hit the debt wall. And I worry that we don't take that into account enough. So that's a little off topic, and I apologize.
Can I just jump in on that? Because I think that's a great point Chris is making. I mean, really, like there, and I couldn't agree more. We should never consider that Canada has the same sort of opportunity set in front of it as the US does. In other words, the US can, and has proven, can get away with things that Canada cannot. And the 90s are a classic example. And I get that interest rates and the interest bite is in fundamentally different zone now than it was in the 1990s. We're not using 35 cents of the federal revenue dollar just to service the public debt anymore. It's what, 10, 11, 12%, something like that. So debt affordability is still more manageable. But man, we never really want to be using the US fiscal path as a rule of thumb that we can apply in Canada. We really do need to hold ourselves to a stricter standard, I think. And that comes with just not being the safe haven. I mean, when the proverbial poop hits the fan, right? People aren't hiding in Canadian assets, right? So you do need to be just structurally, on a sustained basis, consistently demonstrating more sustainable fiscal policy. And I think we have lost our way a little bit on this, certainly at the federal level of late. And it would be, I think, appropriate to maybe reset our direction here.
Thanks to both of you. For the next question, it's one that seems to be changing daily on social media as well as traditional media. Given the risk of the incoming Trump administration imposing tariffs on many Canadian exports, what's the optimal response to the Bank of Canada if this supply shock occurs? And for example, are there significant risks if there are further cuts by the bank to levels below 3 to 3.25%? And how would each of you balance these longer term risks relative to short term needs?
May I start?
Please do.
I think this is a great example of the need to really think carefully about the limitations of monetary policy. So think about what Trump tariffs would do. Let's suppose that January 20th comes to pass and they actually put in place 25% tariffs on everything imported from Canada. Canada's currently exporting about $600 billion worth of stuff to the United States every year. 25% tariff is going to drive up the prices of those things in America. There will be some quantity response as Americans either switch over to other goods or start producing them themselves or just reduce their demand for those Canadian goods. So there's going to be a reduction in Canadian exports. That's going to be, unless we can very quickly take those goods and ship them someplace else, it's going to be a reduction in income for Canada. That takes a slow growing economy maybe to flatline, or it takes maybe a slow growing economy maybe into a recession. And I think it's pretty likely it takes us into a recession. The second thing it does, quite apart from the direct income effect, is that as it did in 2017 and 2018, it just creates a huge amount of uncertainty for the Canadian business sector. And uncertainty, as always has been true, is just a killer for investment. So what we have is a direct hit on Canadian exports and therefore Canadian income. And we have a massive increase in uncertainty that drives down investment. Now, what does the Bank of Canada do? Now, my prediction is that the Bank of Canada would lower rates. But it's not clear to me at all that that's the obviously sensible thing to do. I think it would lower rates because the Bank of Canada fundamentally has one instrument, and it says, oh, there's a lot of, this is bad for the economy, there's a lot of uncertainty, therefore we'll lower rates and we'll help things along. But if there's nothing that the Bank of Canada can do fundamentally for that kind of shock. And even addressing the uncertainty, lowering interest rates by 100 or 200 basis points, which they might do, sure, that's great for investment, but if investment has fallen off the cliff because of uncertainty, then lower the interest rates all you want, it's probably not going to stimulate much investment. So my prediction is that the Bank of Canada would respond in an expansionary way, cutting interest rates. It's not clear at all to me that that is the appropriate response. Just because I think it's a good example where monetary policy can't do that much. And then if it doesn't stimulate aggregate demand that much, but there are other problems that come from very low interest rates, then I think maybe we are getting back into a world that we don't want to be in.
Yeah, I like the way Chris puts this, the limitations and the limits on monetary policy. I think my initial reaction here is that, look, it's not for Tiff Macklem Governing Council, to be reacting to Trump tariffs if they do come to pass. I mean, I think it's for our elected officials, government leaders at the federal level, at the provincial level, really even at the municipal level, to be making our case and trying to circumvent and limit the application of those tariffs. It's certainly going to be those elected officials that are going to think about the retaliation if that again comes to pass. I think there's as much at stake in many border states, so presumably it's U.S. elected officials as well, state governors and the like, that really are on the front lines in terms of managing this issue. Saying that, as Chris points out, I mean, like, if you're the Bank of Canada and you've got an inflation target and a price stability mandate, and you witness an economy subject to a shock such that your assessment of aggregate demand and inflation risk gets radically recast, then you probably do have to expect sort of second order reaction, sort of indirect reaction towards lower interest rates. Whether that produces much relief or sufficient relief, I think is an open question. And I think, again, Chris sort of raises the idea of the bit of the hornet's nest that we risk creating here. Okay, so tariffs, hard to see any type of business investment happening. Exports are, of course, directly impacted. So we cut interest rates, to the effective lower bound, perhaps something like that. And we try to incentivize a whole bunch of additional borrowing by households that are already pretty heavily indebted. I mean, that might get you some growth, but that might not be the optimal or most sustainable way to balance your economy. So again, I think it's obviously a problem we hope not to have to deal with, but increasingly a risk factor that's hard to look away from.
Thanks to both of you. First question from the audience. How do you see the current political instability affecting interest rates this year and beyond?
Well, we've kind of touched on this already. I mean, some
Yes.
of the political instability or uncertainty in the U.S. context, we'll come to the Canadian context in a second here, is chiefly, and at least for the moment, really focused on this, trade protectionism and America First policies that the Trump administration seem intent on implementing. I think, again, we need to take these threats at face value. I think it would be foolish just to wholly discount them and just say, oh, it's just brinkmanship. It's just, a negotiating tactic. We can't be complacent here on these. But, as Chris points out, I mean, this is like a confidence killer, an investment killer in Canada. Think of the uncertainty we went through during the first Trump administration from 16 to 20, when we were trying to renegotiate NAFTA, and we got the USMCA or CUSMA, whatever you want to call it, right? There was a period there where businesses understandably didn't know whether it would be an appropriate decision to be putting down putting their money to work in Canada. And I think those fears and concerns are valid, and they're as valid today, perhaps even more so now than they were in 16, 17, 18. Now, our own political instability, is something that we're coming to terms with here. I think, thankfully, it looks like it'll be relatively short-lived, right? We're going to have Parliament come back on March 24th, presumably have a very early test of the new PM. We'll quite likely have a spring election, and we likely will have a decisive election outcome. So I don't think we're going to be dealing with our own made in Canada political instability for too much longer, but it is going to be happening during this very pivotal stage, this first few months of the Trump administration, where we're going to have a weaker hand on the tiller. That's not exactly great. So I guess my sense would be, and this isn't without picking political favorites, is let's get this political uncertainty behind us in Canada as quickly as we can. Let's get to a strong position with a clear mandate from voters in Canada to our parliamentarians to allow our federal government and our provincial governments to really enact the policies that we need to contend with today's risk factors, Trump, of course, being chief among them.
Yeah, the only thing I would add to that is to say that, my comments about the Trump tariffs and the effect on the economy and the uncertainty and the limitations of the Bank of Canada, those comments I would stick to whether we had domestic political stability or not. Another way to say that is the Canadian political instability that we are now going through and will go through presumably for a few months, I actually think pales in comparison to the Trump created tariffs and uncertainty. And fortunately, we have a central bank that is, operationally independent from the government and is insulated from that day-to-day political ebb and flow. Now, if that changes, I think, then we're into a very different conversation, but hopefully that won't change. And we will go through our nightly news, gorging on nightly news about Canadian political events. But I actually think it's the uncertainty coming from across the 49th parallel that is by far the biggest thing.
Thank you. Next question from the audience. Can you comment on climate change uncertainty and the risks for the neutral rate?
Well, let me just say one thing on this. One of the things that's going on in the Bank of Canada and presumably all central banks today is analysis about how climate change is impacting the rate of growth of potential output. That is sort of the key variable that the Bank of Canada needs in order to conduct its policy. And part of that would also be, how does climate change affect the neutral rate. Okay, and those two things are kind of related. All right. And frankly, I think the way at a very high level, the way that the Bank of Canada and other central banks think about the neutral rate is the way I laid out in my slides. So, so they're thinking about that, but I also think you want to keep in mind that again, and limitations of what monetary policy can do and cannot do. Central banks can't really design tools or implement tools that to address climate change, but they can take very seriously what climate change does in terms of changing the performance of the economy. So I think that's what's going on now, and I'll leave it there.
Thanks, Chris. Next question, and this is interesting in the context of what happened in the 2010s and in 2021. Can you comment on the consequences of using monetary policy, and implicit with this is ultra low rates? Given the risks of allocating capital inefficiently and leading to bubbles in real estate and other durable assets.
Well, so I'll jump in on this, and we talked a little bit about this already. I mean, I think what we've seen in Canada, I just maybe comment on kind of how I've seen things unfold for the last 20 years, is that in many cases, because of some of the structural pressures and failures to deliver productivity growth, we seem like we've needed to lean on relatively loose monetary policy to generate growth. If you thought economic growth was a political imperative, we've needed to get growth in some fashion. We haven't had that really through productivity growth. So we've been using kind of superficial means, you might say, or perhaps less sustainable means of growing the economy. And some of that has taken the form of loose interest rate policy. And we have, as a result, the legacy of that is this really heavily indebted and highly interest rate sensitive Canadian economy that we have today. It's part of why we have affordability and debt management issues still to contend with. And I get that interest rates have come down, and that's helpful, but doesn't give me a lot of confidence that Canadians are going to be in a really good position in 2025 to manage their debts and service their debts. So, some of the issues with having had these structural impediments to longer term growth and our productivity impasse or crisis, if you want to use that word, is that we've had to find growth through other means. And I think we're finding that in some cases that's been less than optimal. We've also, I think, not anything near as extreme as the US, but been leaning on looser fiscal policy more recently to generate growth. And again, we want to be careful here because we have some very hard-won fiscal credentials in Canada, and you don't want to give those away easily or quickly or without something to show for them. So, I think on those fronts, I kind of view those as vulnerabilities that we're still contending with in 2025. And I think part of the reason why we're going to still continue to struggle.
Let me say that, before the global financial crisis, people that talked about monetary policy talked about, low inflation and the benefits for the economy of low inflation and central banks focus on low inflation. And then with the global financial crisis, we started talking in a major way about financial stability. And we have to have central banks thinking about financial stability. And we talked about macro prudential tools. And I think it's quite appropriate that we're having that discussion. Financial stability clearly matters. But then that discussion has sort of disappeared a little bit. But here we're now back to a situation where there has been a very clearly in Canada, but also in other countries, there's been really very rapid rises in housing prices in particular, but also in other asset markets. So we're back to this question about should monetary policy be focusing on inflation, or should it be focusing on inflation plus some other asset markets? And this actually gets back to the mandate of the Bank of Canada, to the mandate of any central bank, which is what should they be thinking about and focusing on? The Bank of Canada, or any central bank, has imperfect tools, period. They have imperfect tools just for thinking about inflation, but they have imperfect tools no matter what you want to give them to think about. But I think there's a very good debate about whether you should incorporate asset prices in a formal way into what the central bank is doing. And while I think financial stability is super, super important, I tend to take the view that we probably should use other tools to enhance financial stability and those macroprudential tools, and let the central bank really focus on price stability. But it's a completely legitimate debate, and it's a debate that's not gone away.
Thank you. We have a host of good questions to get through, but unfortunately we have time for only one more. And if I could ask each of you to regrettably keep your answers brief to a longer term question. But the Bank of Canada's mandate is up for renewal in 2026 with the agreement with the federal government. Governor Macklem focused on this as part of his remarks in mid-December, and just wanted to get your view on the key question that he asked, specifically, is 2% the right target for the bank in its next mandate? And again, apologies for keeping this brief.
Yes.
You win in terms of concision, Warren. That's excellent. Chris?
So notice that his question is 2% the right target? His question wasn't, should the target be something in addition to or something other than, right? It was, is 2% the right target? Presumably the alternatives are not 2%, like 1% or 0 or 3 or 4. Look, I think here I kind of sound like a Bank of Canada apologist, and I don't mean to do so. I think the bar is very high to change the bank's policy. So the bank has had a 2% target since 1995, I think. And up until 3 years ago, the average rate of inflation had been exceedingly close to 2%, right? 2% plus a very, very small epsilon. And I would say that the economy has been through a lot of shocks over that 30 plus years, 30 years, I guess. And we've kept inflation low and stable. So I would say that the past 30 years has shown inflation targeting with a target at 2% has worked pretty well. And you've got to come up with a pretty darn good reason to either lower that target or raise that target or change the nature of that target, including introducing a dual mandate, which sometimes gets talked about. So I'm kind of a big fan of the status quo, unless there's a really good reason to change, and I haven't heard it.
Warren, anything further before we wrap this up?
No, I totally agree with Chris. I think the bar is very, very high. I think the current policy framework is appropriate to be renewed largely as is.
Well, with many thanks to both of you. Unfortunately, that's all the time we have for questions, and there's still a number of very good ones that we could have had the chance to raise. Before we close, I want to thank Warren Lovely and Chris Ragan for sharing their analyses with us today, both in their formal remarks and in their responses in the Q&A. They have again provided valuable frameworks and numerous insights about what to expect from the Bank of Canada.